conditions in Europe are still very weak, and we do believe that we're in the early stages of a recession with a bit further to run, and we're going to see further interest rate hikes as well. Welcome to Key Points for February. This month, our take on the strong performance of financial markets since the start of the year. What do we make of the China reopening, and what does this mean for global growth? And what's the outlook for interest rates given the falls that we've seen in inflation? So turning to the first point, 2022 was a really torrid year for financial assets. Whether they be equities, credit, or government bonds, they all posted appreciable declines over the course of the year. Well, 2023 has got off to a much better tone. We've seen equity markets globally really have a strong performance, posting mid-single digit to high single-digit returns. And we've also seen strong gains in credit markets and government bond markets as well. So what's been going on? Clearly, pessimism had been fairly rife at the back end of last year. Cash positions had been quite high. So there has been some deployment of that as the new year got underway, partly for technical reasons, but partly because there have been some improvements more broadly, which we'll come on to in a minute. However, we don't think these improvements are sufficient to warrant a continuation of these gains, particularly in the equity markets, which we think are still vulnerable. And we do believe that there's going to be a pullback in the coming weeks and months ahead. But we do note that momentum has been strong, and it is encouraging that some of the technical resistance levels in equity markets appear to be broken. So perhaps a bit further upside before we think there'll be some pullback. Now, turning to the second point around the global economy, and particularly the reopening of China. The U-turn on the zero COVID policy, I think, surprised everybody. It just came in a bit earlier than had been expected. But there's no doubt this is having a positive impact on the economy there. Travel has picked up appreciably, particularly around the Lunar New Year. And we've also seen consumption retail sales do much better as well. However, they're still below the pre-pandemic levels. So it's not really a fundamental shift that we're seeing here. It's more just it's coming a couple of months earlier than we had been anticipating. But there is no doubt this will have a bit of a positive impact on the global economy. Growth in China was about 3% last year. We're expecting it to be a bit above 5%. So, a not insignificant improvement, but perhaps not enough to offset some of the weakness we're seeing elsewhere. Now, in Europe, there's also been some positive news. Gas prices have fallen again. Natural gas is now at about 55 euros per megawatt hour. Remember, this had been 340 euros back in the summer. So that's going to have an improving effect as well. The concept of rationing seems to have completely gone as we get into the back end of what had been a pretty mild winter. And again, that's going to be a small improvement from the European economy. But frankly, conditions in Europe are still very weak, and we do believe that we're in the early stages of a recession with a bit further to run, and we're going to see further interest rate hikes as well. But the big question, of course, is what happens with the United States. We continue to see recession looming. There has been a deterioration in terms of the retail sales component. We're seeing, of course, the housing market under pressure. While the labor market remains strong, there's signs actually that's beginning to crack and weaken as well. You only look at the headlines about some of the layoffs from the large tech companies. So the US, we do believe, will be going into recession. And remember, this, of course, is still the biggest economy in the world. Now, what does that mean from the rates perspective? Well, inflation has fallen precipitously, as we really had been expecting, certainly at the headline level. In the United States, remember, headline CPI was above 9% in the middle of last year. Now it's back around 6.5%. Similar dynamics coming through elsewhere. But core inflation, stripping out the volatile food and energy components, is still much higher in terms of the level the central banks would like to see. It's coming down, but not at the pace that they feel comfortable with. As a result of that, we're expecting further rate hikes. Before this video goes out, we're expecting to see the Fed move interest rates there by 25 basis points, a slight decline in the pace of hikes, but nonetheless a continuation there. And we're expecting a hawkish message to accompany that. In the case of Eurozone, we are expecting a further 50 basis points the day after. So again, that's something to look out for. And this will have, of course, the combined effect with the rates that we saw last year of slowing the growth dynamic as we get into the middle of the current year. So it's still not a great outlook from a global economic perspective. Recession is ahead of us. Global growth is still significantly below trend, even although there are some slightly more encouraging signs coming out of China and around these gas prices. Now remember, as always, read the full report on zurich.com/MSME.